Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. My name is CPM Akan, and today I'll be taking you through financial management under the topic of business valuation. So we are moving on to the same topic, but we are almost to the end of the particular topic. Then from there we start another new topic. But now we are finalizing on the same topic. So we are now going to discuss about valuation of bonds, or we can call them debentures, or we can call them debts. Yes, we have actually discussed about valuation of businesses. We have discussed about the methods in which we use to do valuation on businesses. We have also discussed about valuation of shares. And now we are discussing about valuation of bonds and debentures or debts. First and foremost is to understand what is the meaning of the word bond and what is the meaning of the word debentures and also debts. Now, when you talk about bond is actually a form of a debt. This is purely a form of a debt. And this form of a debt is always a long-term debt. Any long-term debt is what they call a bond. In this case, it happens like the government, possibly it's mainly the government or any organization may require some extra money from either from the public or from any other financial institution. What happens there is that if it is the money from the public will bring their money and they are now given certificates. These certificates will now be used to secure their loan plus interest at the end of a particular period that they have agreed. So it is a loan that is actually advanced to the organization or companies. So these organizations here get either loan from the individuals or from the banks. So for that matter, we are now coming up with the word bond. On this bond here, the bond actually attracts what they call interest. Interest is actually the profit towards the financial institution. So the bond attracts the interest, and this particular interest here will be paid by the company or organization to the financial institution. And therefore, this interest is very important, and we call it coupon or a coupon rate. So this word coupon rate is a fixed rate. This is purely a fixed rate that is subject to the amount of loan that you have borrowed. So the loan that you have borrowed will attract a coupon rate, which is an interest or a profit to the bank. In this case now, we can say that this coupon rate here will be subject to the amount you have borrowed from the financial institution. We are calling it the face value. Another word for face value is par value, P-A-R, value. So face value or par value is actually the principal loan. The principal loan. That amount of loan that you have borrowed from that particular financial institution is called face value or par value, or you can call it principal loan. So therefore, in this principal loan will form a basis for calculating the coupon rate. Under this coupon rate, we can now say that yes, we have also what they call the market interest rate. Market interest rate keep on changing period after period, or month after month, or week after week. It keeps on changing. This market rate will either increase or decrease. But the coupon rate here will not increase. It will remain constant from the time you borrowed. You borrowed that particular face value. Now it means in this case that if that interest keeps on changing, we can call it now maturity, yield to maturity. Yield to maturity. Now our yield to maturity is actually the market rate. This is a market rate of return. So this market rate of return can either be more than the coupon rate or below the coupon rate. What will happen here is that if the market interest rate is high, if the market interest rate increases, what will happen with the face value of the loan, it is always this indirectly it is proportional, indirectly proportional. That is to say that if the yield to the maturity increases, the coupon, the value of the face value or par value of the loan will what? Decrease. So for example, if now, for example, today this is now our coupon rate, this is our coupon rate, and then the yield to maturity increases to 12%. This will mean that by the end of the period, when we shall be now determining the value of the face value or a principal amount, it will be automatically lower than the amount we borrowed. For example, we borrowed 1,000 for that matter. So by the end of the period, if this particular yield to maturity increases like 12,000, we expect this amount of money to be down maybe to around 900,000. For that matter, it means that if also the maturity period it decreases below the coupon rate, what will happen with the face value of the bond? It will increase. So therefore, that is what we mean by the word valuation of bonds, determination of debentures or debts with their specific terms. Term number one is we have understood the meaning of the word bond. Number two, we have understood the meaning of the word coupon rate. We have also understood the meaning of the word face value or par value. We have also understood the meaning of the word yield to maturity. Very important. On this note, we can now say there are actually two types of bonds. There are two types of bonds. Two types of bonds. Two types of bonds. Two types of bonds. One is what we call irredeemable bond. Irredeemable bond. The second one is what we call redeemable bond. Now, these two types of bonds are actually classified based on the maturity period. If the bond that has been issued to that particular organization by the financial institution and there is no specific period or maturity period in which the particular debt will be bought back, we call it irredeemable bond. This is the bond that will remain active for the rest of the periods, which means there is no maturity period. In this case, there is no maturity period. Maturity period is the period in which the bond, the principal loan, the face value is now returned or bought back or redeemed by the financial institution. Now, redeemable bond, these are bonds that can be bought back. It can be bought back after the maturity period. So therefore, in this case, we have the maturity period. So therefore, in any question given, it either be redeemable or irredeemable. Now, for the case of irredeemable, we can now say that for the case of irredeemable, the market value of the bond under irredeemable is calculated by interest over the cost of debt. Cost of debt. So for us to calculate the value or the value of that particular irredeemable bond, it will just be interest over the cost of debt. Now, interest here, I can simplify this one by use of abbreviation by saying it is int over cost of debt, like that. And when we talk about a cost of debt, it's different from the value of debt. There is a topic called cost of capital. When you go to the topic of cost of capital, you'll be discussing about the cost of equity, cost of preference shares, cost of debentures, cost of debts, and all other forms of financial instruments. So therefore, we are saying it will be interest over the cost of debt. Now, if there is a possibility of the company paying interest, it means that this particular interest will be attracting what they call a benefit. And therefore, the formula will change if there is a tax, if there is any payment of tax. So therefore, it will be now interest into brackets 1 minus that tax you divide by the value of the debt. So therefore, if I subtract T, it means I'm only calculating now the value of interest. Correct? So the value of interest without tax is this. But if there is tax, it will be interest into brackets 1 minus t. In this case, like for example, if the company tax is 30%, then therefore it will be 30% in decimal is 0.3. Therefore it will be 1.3. 1.11 minus 0.3 gives you 0.7. Then the cost of equity. So you have to mark these particular two elements. The second one is what we call redeemable. Now, when you are referring to redeemable in this case, we are talking about a bond in which we can purchase or there is expiry period. Once that period reaches, the owner of that the owner of that particular bond or a loan or a debenture will buy that particular loan back. So that is what we call redeemable. For that matter, we can now say yes. For me to calculate the bond in this case, I will now say, okay, for me to calculate the value of this one, because I'm buying, I will now take the present value of future interest paid, payable, or I can say receivable depending on who is calculating, correct? So for us to calculate the value of the redeemable bond, I will take the present value of the future interest payable or receivable plus the present value of face value, or we can call it par value. So I have to convert the interest rate I'm paying every period, maybe for 5 years, convert into present value. Then I will add the amount of loan I will be paying by the end of the period. Remember, this is the principle that if you borrow a loan, let me just express this one. If you borrow a loan for 1,000, for instance, this loan 1,000 is payable over a certain period of time, assuming the period of time is 3 years, correct? It means that in the third year, that is now after the year 3, what will happen is that the owner of that loan needs to get 1,000 back from you. But before the period 3 years ending, the owner of the bond will be collecting what we call interest. Correct? Therefore, it means that by the third year, let me just demonstrate using a number line. We have here 0 here, which means the year in which you are not paying, or the period in which you are not paying the interest, but you pay the interest after period 1, you pay the interest after period 2, you pay the interest after period 3, and you pay the interest after period 4. Therefore, it means that by the end of period 1, the owner of that particular bond will require to get what? An interest, not the loan. And then the second period, the owner of that particular bond require also an interest. Then the third period also require an interest. But on the fourth period, this period here, the owner will require now the par value. In this case, it is 1,000. However, this is purely when it is a long-term loan. But if it is a short-term loan, in most cases, if you go to any financial institution, it is calculated based on a monthly basis, whereby they are collecting interest, then they are also collecting part of principal. They are also collecting part of principal. You can see this. That is what is happening at the moment, but that is not the rule. So we are saying that when you are now repaying the loan based on the financial period for a shorter period of time, you'll be paying interest plus principal. But that is not the correct rule. The correct rule here is you are supposed to pay the principal by the end of the period, but you are only supposed to be paying the interest. So let's see examples. As I said, examples are always with our notes. So kindly, if you are not able to get the notes and the examples given, kindly reach us on 0735 346 777, or you can reach us also via WhatsApp, or also be able to subscribe to our YouTube, that is CPM Akan, CPM Akan, SIPS College. You'll be able to find us there, and you'll be in a position to get notes plus questions together. So let's see the question that I've actually prepared. And actually, before I do computation, let me also mention something. In most cases, bonds are given in these terms. 100 shillings. 100 if it's given in the form of 100 units. 100 what? Units. For every 1 shilling, you get 100 units. So in most cases, if a question given does not have the value of the debt, or the value of the bond, or the value of redeemable, what should come in your mind is only 100 units. Therefore, if they say 9% per annum of what? So for that matter, if there is no value of that particular debt, you use what? Your 100 units. Correct? So this is a standard form of calculating the value of the par value of the debt if an examiner has not given the value of that particular debt at the beginning. Okay. So let's see an example. Let's see an example that is there. We have example there, says Fari Limited. This is an example that relates to the redeemable value. Fari Limited has in issue 12% bonds with the par value, that is PAR, 100,000 shillings, and redemption value 110,000 shillings, with the interest payable quarterly. The redemption value yield on the bond is 8 shillings, 8% annually, and 2% quarterly. The bonds are redeemable on 30th June 20x4, and it is now 31st December 20x0. Required, calculate the market value of the bond. So what is very important, check the note and understand whether the question is about the redeemable bond or irredeemable bond. They are saying Fari has in issue 12% bonds with the par value 100,000. So you have been given the par value. Then what is 12% bond? That is a coupon rate. So you can now say yes, extract information, coupon rate, that is 12% per annum on 100,000 bond. Very important. So a coupon rate is 12%, which we have said it is a fixed rate. Continue. And it's a redemption value, which means by the end of the maturity period, there will be a redemption value. Redemption of how much? This one is 110,000. So you will be redeeming, when by the end of the period given, you will be repaying that amount of loan principal, 110,000 above 100,000. So what kind of bond is this? This one is called premium bond. If the value that you are repaying at the end of the period, we call it premium bond. But if you are repaying by the end of the period amount lower than this one, we call it discount bond. So let's see. With the interest payable quarterly. So in this case now, the interest is payable quarterly. It is not in coupon rate. That is now the coupon rate. It will not be 12% per annum, but will be quarterly. So you divide by 4. So it means that per quarter will be 3%. So it will be 3% of 100,000. You will be getting what you call what? Interest rate payable. Then the redemption yield, this one now. There is now a redemption yield. Redemption yield. That is now like a yield to maturity, or the market rate of return. So this is like market rate of return, and it will be purely used for discounting purpose. So the reason why we have the redemption period is to discount what? the interest rate. This is purely for discounting the interest rate. We have been told it is 8% per annum. But in quarterly basis, you divide by 4. You'll get what? 2% per quarter. Correct? Then the bonds are redeemable on 30th June 20x4. So it will be redeemed, it will be bought back on 30th June 20x4. And it is now 31st December 20x0. So let's now count how many quarters are there from 20x0 to 20x4. From 20x0 to 20x4. Now let's see, we want now to calculate the period. The reason why I wanted to do that is to calculate periods. So in 20x0, it is starting on 31st December 20x0. So this one is already over. This period is over. So we go to 20x1. How many quarters are there? There are 4 quarters. Then we have also 20x2, 4 quarters. Then we have 20x3, 4 quarters. But in 20x4, it is not 4 quarters. So in 20x4, there will be how many quarters from January 20x4 to 30th June 20x4? There will be 2 quarters, right? Here we shall be having 2 quarters. So if you add all this one, you will get 14 what? Periods. So this is now our period that we are going to discount. Now, what is the question saying? Required, calculate the market value of the bonds. First and foremost, they want us to calculate the market value of the bond. First, we need to calculate the present market value of the bond. Market value of the bond is given by present value of future interest to redemption period plus present value of par value. So you can see. Now, it is very simple now. I can now say there are 14 quarters. So you can say now period here. Then cash flow in the form of interest. So from 1 to 14, I will be collecting what? Interest. So from 1 to 14, I will be collecting interest. But on 14th year, 14th period, I will be collecting my redemption. Therefore, for this one now to work, I've been told this quarterly, so I will not use 12% of this. It will be 12 divided by 4 times that. So it will give me now, the interest will be 3% of 100,000. So 3% of 100,000 gives you what? 3,000. So this 3,000, it is per period. For how many periods? 14. Then redemption is only taking place at the end of the 14th year. So therefore, this one will remain as how much is being redeemed? 110 redemption. 110,000. Correct? This is what they call the cash flows. Correct? Now, these cash flows here need to be discounted. We have what we call present value interest factor at the rate of, we have said that the reason why you are given redemption yield is for you to use that percentage for discounting purposes. So therefore, 8% per annum. 8% per annum, then you can able to get the present value. Now, look at what they are saying. This is 1 to 14. This 3,000 is remaining constant. When you go back to our first video about value of money, you will find that we are saying we have either present value for per period or we have annuity. So annuity, when we are receiving a constant amount of money over a certain period of time, or we are repaying constant amount of money. So this one is remaining constant for 14 years. So therefore our formula is, which formula is that now? Our formula will be 1 minus into brackets 1 plus r power negative n, everything you divide by r, if the money is constant. But if it keeps on changing every period, then this factor here, we are not going to use this factor. We use now 1 plus r power negative n. Now, because the value is remaining constant, it means we just need now to substitute our formula. by saying we work what is on the numerator first, then we divide by what is on the denominator. You will get now the figure to be placed here. So that now you take 3,000 times that figure, you will get your present value. But for this case now, it will be on 14th only. So therefore, it will be this one. On 14th, we are redeeming 110,000. So if you put your calculator properly or use your present value annuity table, you get the figure here as 12.11. If you use your annuity table or use a calculation, round it off to 2 decimal places. But for the present value annuity table given from your exams, it will be 4 significant figures. So therefore, it will be 4 significant figures here. But if you use your calculator, round off to 4 significant figures and you put your figure there. Then on the 14th period, it will be, which means you use this one. If you substitute now 1.r is what now? 8, which is 1.08 power negative 14. Your answer will be 0.758. And if you are using your present value table, not annuity but present value table, go to the rate 8%, go to the period 14, you will see this figure here. Then if you multiply now, you will get here 330. This one here, this times that you get 83,380. If you now add, because you have been asked, the formula is market value is present value of future interest plus present value of par value. You can see present value of par value, present value of future cash flow. So you add this, your answer is 119,710. So this question is very common in exams. It is between 5 marks and 6 marks. 5 marks and 6 marks. Correct? Example 2. I want you to check example 2 there also. It says a company has issued some 9% bonds, which are now redeemable at par in 3 years' time. Investors now require a redemption yield of 10% per annum. What will be the current market value of each 100 shillings of bond? So in this question, we have to see the difference. The period here is 3. And they are saying we have not been told that the is paid maybe quarterly and what. No. In quarter basis, it will be like this. But if it is, they are saying semi-annually, you will divide here by 2. Correct? You divide here by 2. And then period now here will be, you take, if it is 3 years, you multiply by 2. But in this case, let's see what is happening. A company has issued some 9% bond. So 9% is coupon rate. So we now say, okay, this is example 1. So example 2, we can now say we have coupon rate is 9%. But you see, you have not been told anything about. So there is no value. That's why I was saying that if you have not been given the value, you just use the units, 100 units. But in this question, you have been given 100 units at the end, 100 shillings at the end, which are now redeemable at par in 3 years. That is period now. Investors now require a redemption yield of 10%. Redemption is purely for discounting purposes. What will be the current market value of 100 shillings bond? That is coupon rate. So in this case now, let's multiply by 100. You will get what? 9 shillings. For how many years? 3 years. Now we can now say yes. Market value is given by present value of future interest plus present value of par value. Par value. So therefore, period here, it is a constant from 1 to 3. Then the third here, the third period, you are paying what? There is a redemption. So in this case, it will be an interest here. Then there will be redemption here. Therefore, this one will be 9% of 100. You get 9. Then redemption, you are redeeming how much? 100. That's what you are being told. Redemption of 100. This is cash flow. Then from there, you now discount present value interest factor at the rate of 10% per annum. Then you will have your present value. So 1 to 2, the amount is constant, 9 shillings for 3 years. So which means the formula is this one. The third year, that is now the third year, the formula is that. So if you substitute your formula, if you substitute carefully, you are supposed to get if you substitute carefully, you are supposed to calculate and get it as 1 minus 1.1 power negative so 1 minus 1 minus 1.1 power negative 3. Then you divide it by rate of 0.1. So your answer there is 1 minus 1.1 power negative. I'm getting disturbed with my calculator, sorry. So it is 1 minus 1.1 power negative 3. You get your answer, then you divide it by 0.1. So your answer is 2 point. This one is 2.4869 in 4 significant figures. But for this one, I will use this one because that is just the end of that period. So it's 1.11 power negative 3. So this one is giving me 0.7513. If you multiply now, the last one is 100 shillings, you get 75 here. Then the first one is 9 times 2.4869. 2.4869. You're getting 22. So if you add your figure, you will get something to do with the 97.4 or 97, just 97 flat. So that is how to calculate the value of that particular bond. So that is how to value the bonds, to value bonds or debentures. So we move on. Sometimes you might want to convert this bond into ordinary shares. Sometimes there can be a conversion. So we can now discuss about that. Convertible bonds. That sometimes these bonds here can be converted into ordinary shares. If that is the case, then it means the market value might be different, because we have to convert it into ordinary shares, and whatever that is remaining will remain in the form of what? A bond. Therefore, in this case, we can now say the present value will now be present value of conversion value. The present value of conversion value plus the present value of future interest. Future interest. So we are converting. So if you convert a portion, there will be a portion of bonds that are being converted into ordinary shares. If that is the case, whatever that will be remaining will be attracting what? An interest. Therefore, for that matter, we can say now, this one here, that is now the present value of annuity. So you can now conversion value. Now, for us to calculate the conversion value, we have to ensure that, number one, for how long have you been having that particular bond towards the end of valuation conversion value. In this case, you can say the market value of the bond into 1 plus r power n, then you multiply by r, whereby in this case p is the price of ordinary shares at that particular point. Then we can now say n is the period. This is period to conversion. Then we can now say r is the number of shares converted. So the number of shares converted, this one. So we take the market value per share. Okay. Then for how long? This is now what we call future value of that particular future value. In this case, we call it face value. So future value of this face value. Then once you get the future value multiplied by r, you will now get accumulated value on the conversion value. So conversion is given by the market price per share times the period, that is future value given, times the number of ordinary shares. So in this case now, once you get this, the figure you get, you convert it now into present value. Automatically, present value of future interest is the same as the one in the bond. So let's see an example, then we find out. Example there says, what is the value of 9% convertible bond if it can be converted in 5 years' time into 35 ordinary shares or redeemable at par on the same date? An investor's required return is 10%, and the current market price of the underlying share is 2.5 shillings, which is expected to grow by 4% per annum. Required, determine the current market value of the bond. So let's see the question as it is. What is the value of 9% convertible bond? Have you been given the units? What is the value of the bond? You have not been given. And because you have not been given, you just use 100 what? Units. Bond, if it can be converted in 5 years, that is period, which means this 9% will be converted into ordinary shares of 35 shillings after 5 years. You can see here, 5 years, 35 units. Yes, sorry, ordinary shares. Then they are saying, and an investor required rate of return is 10%. Here, R. No, R is growth rate. I've not indicated actually, sorry. Sorry. This one is not R, but the G. G is growth rate. Now, correct? Now, let's see what is up. There is a growth rate of 2%. So, in this case now, let's see conversion. Conversion value is given by price per share into brackets 1 plus G power n, you multiply by R. So in this case, market value have been given, it is 2 shillings, 2.5. Then it is 1 point, growth is 4%, which is large. Power how many years? 5 years. They are saying 5 years times how many ordinary shares? 35. What is the value? So if you press your calculator well, your answer you will get is 106.46. That is now the conversion value. Then from there, we need now to calculate the present value. So I have already that. So I want now to calculate the value for interest. So interest there. Interest in this case, you have been given as 9%. So 9% of 100 units for how many years? For how many years? 1 minus 1 minus r. Yes, minus 1 plus r power negative n divided by r. Remember, this is consecutive. 9% for how many years? 5 years. So if you work out this one, it will give you 9 times 100 times this one now will give you 3.7 791, which will give you what? 34.12. So this is the then convert present value, this 34% and 106 what percent to fit in the formula present value of cash, present value of conversion value plus present value of future interest. So now if you convert this now, present value here, this one now, so present value of, so I come now with that market value is given by present value, so I have the figure as 106.46 multiplied by the present value. The present value for that matter, this conversion is taking place at the end of the period, which will be now 1 point, at what rate? 10%, 10%, yes. 0.4 power negative 5. This one, then you get your answer as what? This one, this figure will give you 106.46 times 0. If you calculate it well, you get 0.621, which will give you 66.11. Then we go to present value for, this is present value, yes, this is present, no, this is present value, this is present value for conversion. Then we have also another present value, which is the cash flow of 36.12 times its present value of 66. Just a little bit, I think I've mixed up. So I have the present value of 106 gives me 66. Then what about the present value of 9%? Present value of present value of 9% is that. So mine is just now to calculate and add. So P0 is given now by 34.12 plus 66.11. So your answer there will give you 100.23 shillings. So that is how to calculate your bonds. So that is how to value. That is how to value your bonds. So your syllabus also wants you to know how to value the value of the bond by use of what we call market what? Okay, just a continuation, just some few examples. I still have some few examples here. Now for the irredeemable bond, we have not done an example, so I have still more examples here. Irredeemable, let's read this question. A 10% debenture of 40 par value is currently trading in stock exchange at 50 shillings. The corporate tax rate is 30%. Determine the cost of this debenture. The cost. So it is not the value, but the cost of debenture. So in this case, our work will be very simple. So debenture there, we have been given 10% debenture of 100 shillings, 40 shillings per value. What is that? Coupon rate. So you can now calculate your coupon rate, which is 10% of 40. How much is that? 4 shillings, correct? Then we have also been told it is currently trading, which means P0 is now what? 50. That is the market value. We have already been given the market value. So it has moved from 40 shillings to 50 shillings. Then the corporate tax is 30%. T is equals to 30%. So it means that this value here, the interest rate will be affected by interest. Then calculate the cost of equity, calculate the cost of debentures. In this case now we said market value of the debenture is int into brackets 1 minus T over cost of debenture. But now what is missing is this. We have been given this already. So we can substitute and say now this one I've been given there 50 shillings. Then int I've been given as 4 times 1 minus 0.3. You divide by cost of debt. This one will cross multiply, gives you cost of debt is equals to 4 into brackets 0.7. If you subtract, you divide by 50. Your answer is 5.6% cost of debt. Now we go to the second another example that is also there to open our mind also. This is purely testing on redeemable, cost of redeemable. So it will be covered purely also when we shall be discussing about cost of debts, cost of capital. Another example says, Nazir Investment Limited. But before I read this one, let me now, irredeemable, for us to get the rate of yield to maturity, that is, I say this is the market price. This is the market rate in which the shares is attracting the interest. So therefore, we can now say it is given by int into brackets 1 minus t plus into brackets m minus value of debt 1 over n. Divide everything by m plus value of debt. Then you get the average. So interest, if there is tax, then m here, m is the nominal or a par value, and then vd is value of debt. Here value of debt is the market value of the debt. Then n is the number of periods. So let's see from the question. Nazir Investment Limited currently sells bonds at 1,200. Currently sells bonds, which means market value, VD, value of the debt, with an 11% coupon rate at 1,000 par value. So 1,000 is the nominal value or par value, nominal value or par value. So the par value, we have now the coupon rate of 11%. So you can calculate that interest. So interest in this case is now 11% of 1,000 will give you 110. Correct? Then we move on for 18 periods. So required the bond yield to maturity. Then is now yield to maturity is given by int into brackets 1 minus t plus into brackets nominal value minus value of debt. Then you multiply by n. Everything you divide by the average of the nominal value plus value of the debt. You get the average. So if you substitute now int, we have calculated as 110. Then it is 1 minus 0.3, which is 30%, plus nominal value, in this case is 1,000, minus value of debt. Value of debt in this case we have already been given as 1,200. Then 1 over n. N here is 18 years, 18 periods. Then it will be 1,000 plus 200, 1,200. You get the average. If you simplify well this by putting your calculator, you will get 11%. That is your yield to maturity. Yield to maturity. Now allow me to deviate from valuation of bonds to what we call a model called Gordon's model. Gordon's model is purely the model that is mainly used to value the dividends. We have already discussed about valuation of dividends, whereby we say that dividends can be valued based on specific policy. Policy number 1, the dividends can be paid 0 dividend growth rate, or dividends can be paid on constant dividend growth rate, or dividends can be paid based on non-constant dividend growth rate from the previous video. For that case, Gordon model states that when you are valuing the dividends, we are supposed to use the formula as value of that dividend is given by earnings. Earnings in this case is dividends still also, into brackets 1 minus B over K, that is cost of equity, minus BR. In this case, E is earnings, correct? Then B is the retention period, this one here. B, dividend policy. So in this case, dividend policy. Then we have cost of equity. Then B is this still, it is still the policy, dividend policy. and R is the internal rate of return. So therefore, it is saying that for us to value, Gordon model says that for us to value the dividends, we have to take the equity, that is earnings, sorry, into 1 minus B. B is now the dividends you are paying. This one here, the dividends you are paying. For example, you are paying a DPS, maybe dividend per share, or a lump sum dividends. You put there. For instance, you can say earnings maybe is 1,000 and maybe 1 minus. So dividends here, they are saying we are paying 20%. So dividends. So what is that remaining? It's 25%, which is 2.5% over cost of equity, maybe 11%, 0.1 minus BR, which is now 0.25. You multiply by internal rate of return, which will be given also maybe to be 10%. So if you work out this one, you'll get what they call what? Market value based on the Gordon value. So it says that every popular model explicitly relating the market value of the firm to dividend policy is developed by Myron Gordon, which calculates this for principle like that. Another one is what they call the super profits model. Super profits method. So super profits method is another method that is mainly used to calculate the value of the business. In this case, it states the word super profit means you have gained or you have earned profit that is above your expectation. For example, if you normally have the investment in shares, we expect you to have what they call rate of return as profit. Unfortunately, when you now calculate that rate of return compared to the actual profits, which is now sales minus costs, you get the profit. Now this profit you have gotten is different, or it is higher than expected. That is, expectation is based on what? Based on returns. In this case, it will be more. This is how it is calculated. You take the actual profits. Actual profits in this case, it means that is the profit you have just generated from your end year period. So you put it there. Then you less rate of return. Returns pro income. You less returns. Like that. If this is higher than this, it means that there is high profit. Super profits. And this return here is calculated by rate of return times investment. For every investment you make, you must know how much is your rate of return. For instance, if the rate of return is 10%, and how much have you invested? 100,000. For example, your returns is 10,000. But now this is on the investment part. What is the actual profit? How do you get the actual profit? Actual profit now is given by revenue in that matter minus the costs. If revenue minus cost is higher than the rate of required rate of return here, then it means there is super what? Profits. For example, let's see this example that I have there. There's an example down there which says, suppose a firm employs, which means uses 600,000 shillings as capital, correct? Investors are not satisfied with an income of less than 20%. See, the profit is likely to be continued at 200,000. So determine super profits of the firm. Determine super profits of the firm. So super profits of the firm comes in when the actual profit is higher than the return profit from the investment. So let's see. Now, a firm employs 600,000 as capital. That is an investment. Investors are not satisfied with the income less than 20%. So that is a rate of return. They will not accept less than 20%, but will only be counting 20 and above. So what is that? It's called returns. Then the profit is likely to be continued at 200. That is actual what? Profit. So in this case now you can now say actual profits is 200,000. Then returns is 20% of the investment, 600. So your answer there, if you multiply, you get 120,000. So do we have, is actual returns higher than rate of returns? Yes, that is what you call super profits. So here you get your super profits of 80,000. Super profits. So that is how to use the method called what? Super profits. Now we go to the next example there on the same. So in this example, it's trying to tell us how to calculate goodwill. But before we go to that, let's use another model called Maracon model. So these are models that are currently used to do valuation of businesses. So we have discussed about the super profit model, whereby we are saying you take the actual profit minus the rate of return profits. Then we have also discussed about the Gordon model, which states like that. Then we go to Maracon model. Maracon model is a model that was mainly discovered by a person by the name Maracon Invest Associate. Maracon Associate developed a model by saying, for us to find the value of the asset, you get the ratio. You need to get the ratio of market ratio to book value. So market ratio to book value, in this case, you use the market price divided by the book value. That for us to calculate the value of that particular company, you need to take the market value to the ratio of book value. And remember, we said book value is also called what? Carrying amount. If this particular asset keep on increasing, it means that the value of the company is increasing. But if this ratio keeps decreasing, the value of the company keeps what? Decreasing. So in examination purposes, you will be asked to calculate using Maracon model. So Maracon model is a ratio between the market price to the book value. Market price to the book value. There is another one called Walter's model. Walter's model. Walter's model is another model that is currently used nowadays as we speak, but in this case it is saying that Professor James E. Walter argues that the choice of dividend policies almost affect the value of the enterprise. The model you choose to determine the value to pay the dividends will automatically affect the price or the value of the business. For example, if you try to use the zero dividend growth rate, it will automatically affect the value of the business, because it means that there will be no growth rate, but you are paying a constant amount in terms of dividends. But if you now try to shift from that to dividend growth rate, so the growth rate is growing every year, it means you will be paying more dividends and automatically affect the value of the business. And if you now say, let me be shifting or be changing the rate in which we are paying, that means there is non-constant dividend growth rate, automatically it will be affecting also your value of business. And for that case, he gave out the formula by saying the value of that particular element will be based on two. One is what he called current dividend divided by the cost of equity. Then you add the earnings here. Then you now say what the R minus ED divided by K. Then the whole of this, now the answer you get, you divide by K. Let me explain what it means. This one here is the gain on, this one here is the dividends paid, and this one here is the gain on gain from your earnings. That is to say, earnings here minus dividends, you multiply by the internal rate of return, R, internal rate of return. Then once you do that, you divide by cost of equity. Once you get the cost of equity, you divide now all of this answer by the cost of equity. Now this statement means that this one here is dividends and this one is gains. So how is gains? How is it that is a gain? You take the earnings minus dividends you are paying, then you multiply by the internal rate of return. The answer you get, you divide by R, and the final one you divide by K. You get the Walter's model. So that is how you are supposed to calculate. The third one, the last one, is what we call the residual model. The residual income model. The residual income model states that we only do an investment based on what is remaining. Residual is what is remaining. And therefore, this one, for us to calculate this one, can now say the residual income model is calculated by net income minus equity charge. Equity charge. When you talk about an equity charge, we are just talking about rate of return based on your investment. But net income here, it is based on the accounting principle. That is now the revenue minus costs. But we have your own investment that you made into that particular organization with a clear mind of getting an interest at a particular rate. Therefore, you will take now that rate of return times your investment. Now, when you calculate this one, you will find the residual what? Income. For example, there is an example there. It says, if a company X reported earnings of 100,000 last year and financed its capital structure with the 950,000 worth of equity at a required rate of return of 11%, determine its residual income. So this is residual income. So we now look at the question. If X company reported earnings of 100,000 net income, correct, financed its capital structure with the financed its capital structure with the 950,000 worth of equity at required rate of return of 11%. So equity now charge will be 11%. So therefore our work will be very simple. I will now say net income is, in this case, is 100,000. Then equity charge is 11% of 950K. So let me calculate equity charge. Equity charge is 11% of 950 what? Thousand. Your answer is 104,000. 104,500,000. I have already the net income. So therefore, I will now say, okay, residual income is given by 100 minus 100,000. 100,000 minus 104,500. Your answer is negative 4,500. What does it mean? Let's do the interpretation. It means, although the company has reported a profit of 100,000, correct, based on accounting concept, but when we go back to our investment, how much do we put into that business and how much you are expecting to earn at the end of that particular period? We're expecting to earn 104,500, but the accounting principle is giving us 100,000. Therefore, it means that when you use accounting principle, it is a profit. But when we use now the net residual value by factoring in the equity charge, it is giving you a negative. Therefore, it means that this profit is not viable. This particular company is not doing well when we use now the the residual income method, because it is giving us a negative of 4,500. That is to say, equity charge, what was expecting was more than what the accounting concept is giving. That is how you are supposed to do the valuation. So the next topic will be now use of relative measures. That is the next topic, is use of relative measures. Relative measures, I mean now ever and mva. Ever and mva, which is a very common question also in the CASNEP questions, very common in CASNEP questions. That is economic value added and the market value added. So we are going to discuss about economic value added and market value added in the next topic. Thank you so much and have a blessed day. So therefore, subscribe, like, share with your friends, invite more friends to join into this particular YouTube, so that they are able to benefit from these free notes and free questions And remember, I will be sharing the same notes to you via our link and together with the questions, and you can see the workings I've also done. Therefore, welcome and have a blessed day.